It's been a brutal week for the cloud kings, the worst in recent memory. And for all I know, they might have further to fall. We've been conditioned to believe these software as a service or SaaS stocks are mostly immune to the slings and arrows of the business cycle. We assume that their clients would keep paying up to migrate away from expensive on-premises software to the cheaper, faster, better cloud. But now we're hearing chatter that this great secular growth story is starting to, let's say, come to an end. It all started at Workday's analyst meeting on Tuesday. CEO Neil Bushry, friend of the show, said, we're definitely seeing some delays when it comes to the human capital business. And delays are the last thing you want to see when you got a stock that's selling for 100 times earnings. So even though Workday's stock had already fallen from 226 at its highs over the summer to 181 right before the meeting, the stock plummeted another 20 points the next day. And you know what? Since then, it's fallen another $5. Worse, Workday did a great job of spreading around the pain. They told us that they want to get into the procurement business, which is currently the domain of Coupa Software, a stock that was up 150% for the year earlier this week. No wonder Coupa's been clobbered from 160 down to 128 as of today. Why does Workday want a piece of the procurement business? The analysts who cover the stock hinted in various ways that it must be because their core human capital software business is slowing. So they must enter a new vertical. That kind of competition tends to terrify investors. Then there's the unthinkable happen. Citi downgraded Adobe. That's right. I mean, they actually just downgraded it. And Morgan Stanley, it slashed ServiceNow from a buy to a hold. Adobe had already fallen from 313 to 279, but it lost another 14 points since the downgrade. ServiceNow sunk from 303 to 274, but it's off another $31 since the downgrade. What was Citi's reasoning for the downgrade? They don't like the risk reward in Adobe, and they think some of the company's digital commerce businesses may have weaker prospects than Wall Street believes. As for Morgan Stanley, they condemn ServiceNow as too expensive, given that the company needs to boost its R&D spending to stay ahead of the pack. Oh, man, these downgrades, they were just so devastating. Well, ServiceNow reports next week. Maybe it can rebut the presumption. Final blow. Oddly, Mark Benioff, the co-CEO of Salesforce, is on a book tour for Trailblazer, and somehow that resonated negatively for Salesforce's stock. Some thought Benioff was too self-deprecating. Others questioned how he could spend time doing business and promoting his new book, Trailblazer. Still others didn't like what he had to say about regulation. He called for Facebook to be broken up because in his eyes, it has too much power over the media. Now, at first, I didn't think any of this stuff matters. I mean, it seemed too petty, especially since Salesforce reported the best quarter of the group last earnings season. But even these minor peccadillos took the toll. And because Benioff's one of the people who pioneered the software as a service concept, anything negative about him tends to tarnish the whole industry. As stupid as that is, all these negatives have coalesced to trash the entire group, leaving the cloud stocks in tatters. And by the way, it has not helped one bit that there is aggressive insider selling in many of these stocks. Can tech advance without the cloud? Oh, it'll be tough. I mean, think. On Wednesday, IBM reported a widely panned quarter that included verbiage claiming there was a slowdown in spending, enterprise spending, from Germany and the UK, two key markets for the software as a service space. And by the way, of course, they were hurt by Brexit or whatever. Now, plus, while there's been a break in new IPOs because we got so oversaturated, once the deals start flowing back, money managers may have to start selling these stocks again just to participate in the new offerings. Heavy millstone. So what could turn the cloud cohort around? Because, we always like to look at the other side in Mad Money. I think your best bet is Adobe. They hold an analyst meeting on November 4th. If CEO Shantanu Narayan raises his growth forecast, it could ignite the entire sector, which I believe is now heavily shorted. Barring that, at some point, bargain hunters will start coming into the group, although it might take a while because these stocks are hardly bargains when it comes to price to earnings or price to sales. This cloud sell-off feels different to me. I think it's a signal that these companies are more economically sensitive than we thought, and they may be out of their long runways. Competition's coming. So their price to earnings multiples need to come down. Maybe we're in the third inning, fourth inning, no longer in the first inning for certain. Yet the cloud's lost its luster. You can still own one in case we get some kind of bounce. Look, Untouchable Trust still owns Salesforce. But other than that, these stocks are becoming a bit of the untouchable stock until we get something genuinely positive about software as a service companies. And who knows when that will happen? Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.